Today, I want to show you how you could possibly save $1 million in taxes during your retirement. And I'm even going to share the software that you'll see me use in this video. But first, a story. So a potential client called me and he opened with, I have $2 million in an IRA. And I can't even explain it, but the way he said it, it sounded like he was bragging, like I should be impressed. As an aside, he later told me his annual fee would probably buy me a new Mercedes every year. One, we had not talked about his fee. And two, I don't think he's checked car prices in a while because I don't think my annual fee would cover a Toyota Corolla that doesn't drive anymore. But anyway, that's not the point. Maybe it was his tone, but I couldn't help myself. And I said, well, you really only have 1.3 million, maybe 1.4 if you're lucky. He was taken aback and he said, what do you mean? So in just a minute, I'm going to tell you the rest of the story. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Okay, back to the story. I explained that every time you put a dollar into your 401k or your IRA or a tax-deferred account, you have a silent partner. The federal government and often your state government will give you a tax deduction at your current tax bracket. And that money is going to grow and compound for decades. And then later, you're going to have to pay taxes on that amount when you take it out. So if you have $2 million in your account, after you pay taxes to the state and federal government, and he was in California, you really only have about 1.3, maybe 1.4 million after taxes. And honestly, it's a brilliant strategy on the part of the government because the government counts on our desire to save taxes today. And in doing so, it creates a much larger tax burden in life. So let me just show you some simple math about how this works. So let's say you contribute $1,000 a month to your 401k and you work for 30 years. During that 30-year period, you would have contributed about $360,000 to your 401k. So you would have received a tax deduction each year for about $12,000. And let's imagine that you had a great market tailwind. So you were a very aggressive investor and you made about 10% annualized in that account. Over a 30-year period, that $360,000 that you put in, you received a deduction for, it's going to grow to about $2 million. So you received a deduction on the $360,000, but now you have to take that money out to live in retirement. And when you take out that $2 million, you're going to pay tax. And you're often going to have to take that money out at a higher tax rate than what you received the deduction at. And it gets worse. Not only could you have to pay higher taxes, but it also can cause you to pay tax on your Social Security and additional premiums for your Medicare, and you get nothing in return. So at this point, he was intrigued and he said, what can I do about it? And so I said, I'm glad you asked. And I walked him through how we help clients avoid this problem. And so today, what I want to do is I want to take numbers that are essentially the same numbers that this person on the call gave me. And as I walk you through this case study, I want to show you what the problem is and how you can navigate around it. So in just a minute, I'm going to switch to my other screen and we are going to once again meet Phil and Claire. If you've watched this channel, you know I am a big fan of Modern Family and we often use Phil and Claire for our case studies. So let's dive in. So here we have Phil and Claire and their numbers are very similar to the person I talked to on the phone. He had about $2 million in his tax-deferred account, $300,000 his taxable account, and 200,000 in the bank, so around 2.5 million. And he wanted to retire at age 62. And so in this scenario, they're going to retire at the age of 62 and they're in great shape. We can look at the cash flows and we see here, so you can click in here. And like I said, I'll let you play with this software later, but we can look in here in the summary and we can see that Phil and Claire, when they retire, are going to spend about $85,000 a year when they start out, and then we inflate that number up just a little bit. But one of the things you'll first notice is that basically, if Phil and Claire don't do anything, they're going to pay almost no money in tax early in retirement. And I see this all the time. Someone retires and they're able to keep their taxes really low because in Phil and Claire's case, they are spending the money in their bank account and their taxable brokerage, they have about 150,000 in gains in this case, but they're able to keep their tax payment very, very low. And so for the first, I don't know, 7 years of retirement, they basically pay zero in taxes, and they're feeling really great about themselves. Their portfolio is still growing, and they're paying almost no money in taxes. But there's a problem. If we kind of scroll down and we start looking at the cash flows, all of a sudden some income starts kicking in right here in 2023. Now their Social Security is kicked in because they delayed Social Security. So now they have about 91,000, and then once both their full benefits have kicked in, now they have about $102,000 a year in Social Security. If we come over here at the tax payment, once again, we see taxes are really great. They're not paying very much in taxes at all. But then something happens right here at age 75. Now they have $208,000 in additional income, and they have a $50,000 tax bill. Well, they're living on like $100,000 a year. They don't need all this extra money. But what happens is when you hit age 73 or age 75, it changes depending on when you were born. The government begins forcing you to take a portion of your portfolio out each year, and that amount continues to grow. So first year, their planned distribution is $208,000, and then it's $224,000. And by the time they're 80, they're pulling out $320,000 a year from their portfolio, not because they want to, they don't need the money, but because the government is forcing them to pull that money out. And so now their income is over $400,000 a year, and they don't need this income. And so now instead of paying $0 in taxes, they're paying $70, $80, $90, $100,000 a year in taxes. And this doesn't only cause them to have to pay additional money in taxes, but it also causes them to pay more money for their Medicare. So let's go over here to the tax tab and look at this tax situation in a bit more detail. And so you can see here, by the time they reach age 78, they're in the 24% tax bracket. And then if one of them were to pass, so in this scenario, one partner passes before the other, they're in the 35% tax bracket, the highest taxes they've ever paid in their life. So let's dive into this a little bit deeper. So here we have our tax software. By age 78, in this scenario, Phil and Claire have a total income of $366,000. Now, remember, they only need about $100,000 a year to live. And now as they age, they're traveling even less. And now they have all this income coming out. Not that they want coming out, but they're forced to take it out. So you can see here that their taxable income is $325,000. They're in the 24% marginal tax rate, and almost their entire Social Security benefit is being taxed. Now, before some of you say, wait, how does someone have a Social Security benefit that large? This has been inflated into the future based upon, I think, a 3% rate of inflation, and they both had decent benefits before. So in this case, they have $386,000 in income, but it gets worse. So we go down here and we see, so now we see they're in the 24% tax bracket, getting awful close to the 32% tax bracket. And if one of them passes, they're going to be in the 35% tax bracket. But in addition to that, now they're paying significantly more for their Medicare premiums. Because as you know, if you earn too much money in retirement, you have to pay more money for your Medicare. And some people say, well, what do I get for the extra money? You get nothing. You just get the pleasure of paying more money. And it's a cliff. If you go $1 over, you trigger it. So there's a number of thresholds. So the first threshold, you pay an extra $74 for Part B for each of you, and you pay an extra $13 for Part D. Not too bad. Next threshold is $185 for Part B. The next threshold, and this is where they are now, is $295 a month plus $57, right? So it's almost $350 extra per person because of this Medicare surcharge. And if they were a single filer, this problem gets even worse because these numbers basically get cut in half. And so it's not unusual to see someone in retirement after they lose their spouse potentially paying the highest Medicare premium of their entire life. Well, now that we know the problem, what can we do about it? Well, there's a couple things you can do. First, if you look here, you've got these tax brackets. You've got the 10%, and you got the 12%, 22, 24. One mistake that a lot of retirees make is they try to keep their taxes as low as possible early in retirement, and they don't effectively use these tax brackets. Because in this case, If they would just taken out a little more each year early in retirement, even if they didn't do any Roth conversions, they would have helped reduce those account balances so their RMDs would be much lower and they would have had much more control over their tax bracket. So the answer isn't always doing in Roth conversion, particularly if you have a smaller account balance. When you get a large account balance, like in the person who's on the phone with me, where it's a $2 million balance, you're probably going to want to do some Roth conversions. But for a lot of people, one of the smartest things you can do is use the tax brackets to your benefit, right? So instead of just leaving all the money in that tax deferred account, fill it up to the top of that 12% tax bracket so that you're getting as much money out of the tax deferred account as possible in the most tax efficient manner. But the other thing you can do, and if you watch this channel, you know about this, but you can do what's called a Roth conversion. So let's go back over to Right Capital. We're going to click on the tax tab. And we're going to say, what would happen if they did some Roth conversions? So what if they converted to the top of the 12% tax bracket? So we're going to refresh it. And in this scenario, converting up to the top of the 12% tax bracket could mean 1.6 million more in tax adjusted ending assets and could save them $1.3 million. But we could also play with it some more and say, well, what if they converted to the top of the 22% tax bracket? And what we find is there's actually diminishing returns. Going to the top of the 22% tax bracket, while it does save them more money in taxes, it reduces their tax adjusted ending assets. Now, one of the things we haven't taken into account is the terminal tax rate. Maybe they want to leave some money to heirs and their kids are doing quite well in their career. And so maybe they're in the 22% tax bracket. Because one thing you have to remember is that at the end of your retirement, if your money in a tax deferred account goes to your heirs, they have to take out all the money within 10 years. And so if they inherit $1 million, they've got to take out that $1 million over a 10-year period of time. And by the end of the 10 years, it has to be completely wiped out. So if the people who inherit your money are in a decent career, that's going to really push them into a higher tax bracket. But let's assume in this case that your heirs with the inheritance are going to be in the 24% tax bracket. So we're going to refresh it. Now you see the tax adjusted ending wealth jumps to 1.5 million because it's not just about your tax savings, but it's also about the tax savings of future generations. And so you save 1.9 million in taxes, but your heirs also save money in taxes. Okay, I'm going to leave it there. But what I hope you remember from this video is that many people watching have a ticking time bomb in their tax deferred account. And if they don't manage it today and create a plan for getting that money out, it's going to be really hard to control later in retirement. So if you make a plan today, you can get the money out in a more tax efficient way, often depending on the size of your portfolio, saving you hundreds of thousands of dollars and potentially over $1 million in taxes over the course of your retirement. There are all kinds of things we could talk about, right? Maybe you retire a bit early so you have more room to convert at a better tax bracket, right? If you're trying to decide, do I work a little bit longer and you're on the fence? Maybe it makes sense to go ahead and retire. And it gives you more room. And then think about bracket management, right? Even if you're not going to do Roth conversions, use the tax brackets to your advantage and make sure you're thinking about that every year. What's the best strategy? I then think about how does all this interact with Social Security? Often what we find is that delaying Social Security creates a larger window to be able to more efficiently either pull money out of the tax deferred account or to begin doing Roth conversions. And then you've got to think about healthcare and IRMA and state taxes. And then there are phase outs you need to be concerned about. For example, in the One Big Beautiful Bill, we have a couple new phase outs that we have to think about as we're doing Roth conversions. And I could go on all night. There are a ton of different implications. So what I want to do is I want to give you access for 90 days to the software that I'm using. So in the description below, I will put a link to the software. And then also I'll put a QR code for those of you who are watching on your smart TVs at home. We'll put the QR code here and you can scan that, get access to the software if you haven't already. And if as you were watching this, you were thinking there are so many moving pieces, I need to work with someone to help me figure all this out, I would be honored if you would consider working with my firm. And you can find a link in the description below to schedule a free strategy session. We would love the opportunity to work with you. And if you're looking for another video to watch, here's a video on why you should not do Roth conversions, and you can watch it now.